Our top financial story this morning is that Morgan Stanley earnings report, a big beat for Morgan. For reaction, we're joined by one of the most accurate analysts on the bank, according to the Bloomberg data we have here. That's Charlie Peabody. He's partner and analyst at Portales Partners. Thanks so much for coming in studio today. The market certainly seems to be cheering these results. You know, the beat on revenue and in earnings perceived to be quite positive in terms of what's ahead at Morgan Stanley. What's your take?
Oh, I think the beats were positive. But when you look at their success relative to the others in the industry, it still suggests they have a ways to go. And as you probably know, they're investing heavily in the platform of their trading business, which really accounted for the $1 billion of surprised upside revenues. Well,
it was trading and fixed income that really helped their competitors out as well. What's the outlook there in terms of the overall environment right now, rising interest rates and the global climate? How does that perhaps complicate that reliance on those parts of the business?
Well, let me answer that in two parts. First of all, fixed income, currencies and commodities, has been what's driving the revenues in capital markets. And that's at record levels. So it's hard to see how that sustains itself. But if you look back over the last 5 quarters, 3 out of those 5 quarters have been, quote unquote, unusually high. So maybe we have a cyclical boomlet in capital markets. But what we really are anticipating is that the fixed income will pass the baton in this relay race to equities and M&A, and that's where the incremental strength will be seen this year.
You know, Ruth Porat, the CFO at Morgan Stanley, on a call said that individual investors aren't as active, something that many thought, right, that the retail investor isn't as active in today's marketplace, and that's hurting their brokers, keeping them from making as much money as they could. So if Morgan Stanley is relying more and more on wealth management as a division, how does that complicate things for them?
Well, that's part of the drag of this year. They're still integrating the Morgan Stanley Smith Barney operations. It does result in a higher comp ratio. If you look at their comp ratio, it's around 49, comp to revenue is around 49%. Other banks are in that 35, 40%. And it explains in part why they have a lower ROE, a 17% ROE, whereas these other banks are producing 20, 25% ROEs. So they've got a ways to go to improve the efficiency of that operation.
And they're less active in iBanking as well in some ways. That would create less product for them.
Well, investment banking is still very important, and I think you'll see the strength of their platforms in equities and M&A will start to produce better returns in the second half of this year.
So how long, you just said they're not quite there in terms of full integration of the two wealth management behemoths here. How far before they truly see the positive end of that integration?
Well, I think you'll see much better earnings, assuming the environment remains the same in 2012. But keep in mind, they're still dealing with legacy problems. For example, in this quarter,
real estate, commercial real estate portfolio.
Exactly. I mean, Mac had them investing in private equity, commercial real estate, fixed income, proprietary trade at the peak of all those cycles. And so the drag from those are still hitting the asset management division, which is very weak because of commercial real estate.
How long are they going to be paying for those mistakes?
Well, I think through the balance of this year, there's going to be a drag from those legacy mistakes.
Quick sort of reaction here and outlook on what's happening with regulatory reform and how much cost there could be to Morgan Stanley. During the break, you were telling me JP Morgan could really take a sizable hit if Blanche Lincoln's suggestion as to how to regulate derivatives goes through. What's the worry on the regulatory front for Morgan?
Yeah. Well, I think it's twofold. Does their business model get changed because of the imposition of something like the Volcker Rule? Our position is no, that will be watered down, and they'll be able to keep businesses like prop trading, private equity, and hedge funds. Then the other part is, will this extreme derivatives amendment cause the way they do business to change, forcing trades onto the exchange-traded companies? And if it does, that could be very costly, anywhere from $900 million to $2 billion at JP Morgan is the estimate. So derivatives are probably anywhere from 7 to 15% of a large capital markets-oriented bank's revenues.
Does that make it into legislation?
Well, we're doubtful about legislation, and if it does pass, we don't think it'll be, in the current form, will be watered down.
Of course. All right. Thank you so much for your analysis here. Charlie Peabody joining us in studio.